Good morning, students. Today we're going to understand about ratio analysis. Okay. So, have you all heard about ratio analysis? What is ratio analysis? What is the relevance of ratio analysis in understanding the financial statements? Ratio analysis is nothing but analyzing the financial statements in terms of ratios. Yes, as a common man, what is an understanding of ratio? In maths, we have all learned what is a ratio, what is a proportion. Yes, ratios is, for example, you and your friend have to share something, right? So you'll share, like, I'll have this half, you have this half. Yes, this is what this ratio is about in a normal, common man's language. But when it comes to your financial management, accountancy, or financial statement analysis, what is ratio analysis? Ratio analysis is nothing but an understanding of the financial statements. Yes, the understanding of financial statements such that a normal man, an investor, understands what is it and what is its relevance in a person putting his money into a company, right? So in this analysis we are going to understand what is the meaning of ratios, yes, objectives, uses and limitations, classification of ratios. To begin with, what is the meaning of ratio analysis? Yes, so it presents the relationship between the items in the financial statements. When I'm saying items in the financial statements, your financial statements are first your income statement, your balance sheet, cash flow statements, right? So when it comes to your profit and loss account, that is your income statement, it shows the profitability, right? So there are many items of expenses and incomes. Yes, this is compared with the turnovers, whatever sales the company makes, right? Next, coming to your balance sheet, there are certain balance sheet ratios, whether it is debt equity ratio, whether it is long term debt related ratio, yes, shareholders funds ratios. So all these ratios helps us to analyze your capital and debt comparisons, right? Next, what is ratio analysis helping you as a tool of financial analysis? You're studying the financial performance as a management accountant. You're guiding the management to take decisions. Yeah, right. You're giving impression, or you're giving an information relating to the financial position of the company. What are the strengths and weaknesses of the business, right? So it quantifies the company's liquidity. What is the operational efficiency and profitability to evaluate the company's performance? What are the objectives of ratio analysis? Yes, a firm's strengths and weaknesses are analyzed, right, based on the past performance of the firm. Yes, I am analyzing as a management accountant the past performance. Based on the past performance, analysis of ratios are made for what? The reason here I'm making a ratio analysis to make future projections. Yes, who are interested in this? Shareholders, investors, creditors, and government. How are they interested? Yes, I as a shareholder am investing. Yes, I'm an investor and a creditor who's supplying goods. Yes, why should I supply goods? What is the credit rating of this organization? Is the party in a position to repay the debts on time? Yes, the supplier satisfaction levels to help to make suitable corrective measures when the financial conditions are unfavorable, whether the company actually makes the payment, whether it meets its commitments. Yes, so to compare the present performance with the past, ratio analysis is best to do. Now, to understand the uses of ratio analysis. Yes, the most important use of ratio analysis the management uses for decision making. Yes, so financial forecasting and planning is done. This is communicated to who? To the investors, to the creditors, to the shareholders. Yes, how does it happen? There is a coordination with them. Yes, there is a control where each level is answerable to the other, and finally, the decision making processes happen. Next, utility to shareholders or investors. So, what is it? Profitability ratios, it is helping in determining the profitability position of the company. These long term solvency ratios, what does it help, or how does it help the investor? The investor is able to assess the financial position of the organization. Next, when it comes to the utility to the creditors, how are the creditors benefited? These ratios, for example, your current ratio, your asset test ratios, or your quick ratios, it is giving an expression impression that the ideal current whether the company is having an ideal current financial position, right? For example, when I'm telling current ratio, yes, the ideal current ratio is 2 is to 1. That is, if my current assets is 2, my current liability is 1, what does it mean? For every 1 rupee of my current liability, I should have 2 rupee worth of my current asset. That is nothing but twice your liabilities. That is, you should be stronger to pay off your short term liabilities, right? Next, utility to employees. I, as an employee, what do I expect from this ratio analysis? Yes, I understand whether I'm going to incur better benefits as an employee, whether there will be an increase in my wages. Because if my company is making profit, yes, I am indirectly benefited in the form of increase or increment in my wages, right? Next, utility to government. Any industry that grows, the government reaps its benefit through better taxes, and new policies are framed to benefit the company as well as the government, right? Next, let's understand the limitations of ratio analysis. So, what are the factors which ratio analysis ignores? It ignores qualitative factors. Yes, so trends are not the actual ratios. You are analyzing from the past. From the past, you're projecting something in the future which may not true. There are contingencies. For example, the pandemic was one of the contingencies which was not expected. The impact was too strong, and the impacts are there even today, right? Then defective accounting information. Yes, your past is taken as a basis to make the current decisions, which is not perfect, right? So there are changes in accounting procedures, that is another limitation. Then your operating conditions are not the same. There are changes in the operating conditions which are ignored in ratio analysis. And just a single ratio analysis, does it help? No. It is insufficient to take proper decisions. Next, use of standard ratio. Every comparison is based on the standards. From what basis is the standards? Yes, so this use of standard ratio is another limitation of ratio analysis. Most important thing is classification of ratios. How and on what basis are these classification done? First, liquidity ratio. Liquidity is nothing but the short-term financial position of the company, right? So your current ratio, your quick ratio, it gives us an idea what is the current short-term financial position of the organization. Profitability ratio, whether it is gross profit ratio, operating profit ratio, your net profit, or return on capital employed, we get to know the profit earning capability of the organization based on whatever sales it's making, based on its cost of goods sold. Is the company actually reaping profits? Next, solvency ratio. In the long run, that is the long term financial position of the company. When you're taking the debt equity ratio or interest coverage ratio, when I'm telling interest coverage ratio, that is my ability to pay off the interest, basic interest on the principal amount, right? I have taken a loan. Yes, I have to pay a monthly interest. Whether the company is able to pay it on time. Yes, so that is solvency ratio. When it comes to a turnover ratio, whether it is fixed assets turnover, inventory turnover, or receivable turnover ratios, we're getting to know in comparison to the turnover or the sales made, what is the fixed assets or what is the inventory or what is the receivables. All these are compared to the turnover. It's also called as your activity ratios, right? Next coming is your earning ratio, profit earning ratio, your earnings per share ratio. When I'm telling earnings per share, yes, so the net profit that is available to the equity shareholders divided by the number of equity shares. So what is the earnings per share, right? So this lets us know whether the earning capacity of the company is doing really good. So classification of ratios has a very important role in decision making, whether it is profitability ratios, turnover or activity ratios, or financial ratios, market test ratios. Now, when I'm telling market test ratios, these are some profitability ratios where what is the consideration here? Considering the market value of the shares. What is the impact of profitability? Whether it's creating an increase or decrease in the market value of the shares of the organization, right? Next. So these are the basic classification of ratios, the gist of all the ratios, whether it is financial, activity, profitability, or market test ratios, right? So let's see how much of the concept you've understood through these MCQs. So the first MCQ, the business firm is measured by the ability to satisfy its short-term obligations as they become due. Through which ratio? Liquidity. Okay, so through the liquidity, a business firm is measured by its ability. You are able to meet your short-term obligations. How do you know? Liquidity ratio helps. Perfect. Next, which of the following is not true about ratio analysis? First thing, it is affected by price level changes. Second, it is difficult to evolve a standard ratio. Third, it can give false and misleading results. Fourth, it is not useful in inter-firm and intra-firm comparison. So all the first, second, and third, if you see, it is not. It is true. Price level changes, yes. Standard ratio, yes. False and misleading, yes. What is not true is it is not useful. When you're telling it is not useful for inter-firm and intra-firm, then for what is it used? So that is true, but the following is not true about ratio analysis. When you're telling it is not useful, that is untrue, right?